So in this video, I'm going to be solving an example on CarryBack capital allowance. Ultimate Limited is a company engaged in production and sale of new cookers. The company ceased business on May 31st, 2020 due to stiff competition from importers of fairly used cookers. The company achieved an annual gross turnover of 100 million in 2019 and 2020 before cessation. That line of 100 million is just trying to give you a hint that the company is not a small company. Okay, so it means they can allow for capital allowance. That's very straightforward. The results of the company revealed the following for the year ended December 31st, 2012, 2013, 2014, 15, 16, 17, 18, and 19. So these are all the accessible profits up until 5 months ended May 31st, 2020. Do you understand that? So these are all the accounting years. All these years you can see here, as in year 2012, year 2013, on and on till the date of cessation. And these are the profits. Then they said the company's claim for capital allowances are as follows. Assessment year 2013. You see, this one did not start from 2012. It means 2013 assessment year is the same thing as 2012 accounting year. You know, basis period now is always on preceding year basis, so that makes sense. So capital allowances from 2013 up until 2020 years of assessment. Then they said balancing allowance after disposal of all company's property, plant and equipment on cessation of business amounted to 2,350,000. You can see that. Required, compute the company income tax liabilities for 2013 to 20 years of assessment or assessment years, taking into consideration the relevant provision for the Finance Act 2019. You start by writing the name of the company, Ultimate Company Limited, right? Then what did they ask you to do? They asked you to compute company income tax. So you would say computation of company income tax. Write it in full for 2013 to 2020 year of assessment. 2013 year of assessment, right? They gave you your assessable profit. So you start with your assessable profit. What was your assessable profit for 2013? The assessable profit for 2013 is given as 1.8 million. Then you deduct your capital allowance. And in my introduction, I said CarryBack capital allowance. Yeah, let me explain that. CarryBack capital allowance is a situation that arises during cessation of business, when a business ceases operations and then they are unabsorbed or unutilized capital allowances. You can carry those capital allowances back for 5 years. Okay, so this illustration is just going to show you what that is. It's very simple, and then it's just helping to refresh your memory on capital allowance, on the restrictions and all of that. Okay, so they gave you capital allowance for 2013 year of assessment. Don't forget that 2013 year of assessment is 1st of January 2012 to 31st of December 2012, right? The preceding year. Don't also forget your currency. The capital allowance that was given was 1,950,000. First of all, the capital allowance is even greater than the profit, so they cannot absorb one. And there is a restriction on capital allowance, right? For a company, apart from manufacturing companies and agro-allied companies, the restriction of capital allowance is to 66 to third. Okay, so capital allowance, right, restricted to 66 to over 3% of our accessible profits. Right? So when you calculate 66 to over 3%, or just say 2 over 3 of accessible profits, 1,200,000. So it's only 1,200,000 that you can absorb in this year of assessment, right? So if you can only absorb 1,200,000, it means you will carry forward how much? 750,000. So this one we call unabsorbed or unutilized capital allowance. So relieve it now. 1,200,000. It means you will have your what? Your total profit or taxable profit right here to be 600,000. It is upon this you now apply what? Your CIT will be at 30% of taxable profit, which will give you how much? Should that be 3 times 6 to be 18, right? So that would be 180,000. Then EDT, 2% of accessible profits, and that will give you 36,000. So you are done with right? So you are done with 2013 year of assessment. Then you move to 2014 year of assessment, right? 2014 year of assessment will be account of 1st of January 2013 to 31st December 2013. So they give the assessable profit to be 2,300,000. Then you less, once you have your assessable profit, you less your capital allowance. Now there must be capital allowance that was brought forward. Always check, look at, see what was unabsorbed here. You bring it forward, okay? So capital allowance brought forward, the balance brought forward is what? 750,000. Then what is the one for the year itself? Check inside your question. You see that for the year you have 920,000. So this is the total capital allowance for the year, 1,670,000. This is what you want to absorb, right? This is for the year. So this will be your total capital allowance. So what can you absorb? Can you absorb everything? Even if it is greater, even if there's available profit to absorb everything, test the restriction. Do 66 to over 3% of assessable profit, okay? When you do 66 to over 3% of assessable profit, you get 1,533,333. Can you see what you got? So this is the only thing you can relieve. You must not relieve above 66 to over 3% of assessable profits. Even if your assessable profit is available, you can't relieve more than 66 over 3. But for companies like manufacturing companies and agro-allied products companies, you can relieve everything as far as the profit is available. So this is what you relieve for the year. The restriction, right? 66 to over 3. That's what you relieve for the year. So you're going to have 136,667 as unabsorbed, right? Unabsorbed capital allowance. So this you know your unabsorbed capital allowance that you carry to the next year. Now go and deduct this capital allowance from your assessable profit so that you can get your taxable profit or total profit. Now 766,667, right? So this is your total profit. Then you can now get your CIT at 30% and your EDT at 2%. Let's not waste our time writing that one. This question is long. Okay. So let's go to 24. I'm trying to reduce my writing. Let's go to 2015 year of assessment. So 2015 year of assessment, you write your assessable profit. What is the assessable profit that is given? Check your question. 3,500,000, and they gave you your capital allowance. So remember that you're going to bring forward capital allowance, right? How much are you bringing forward? You're bringing forward the one absorbed here in 2014 year of assessment, which is 136,667, right? 136,667 naira, right? So then your capital allowance for the year is always given in the information. So you check your question. Capital allowance for the year is 1,350,000. So this is your total capital allowance for that year is 1,486,667, right? So this is your total capital allowance. You now ask yourself, what is 66 to third of this? Can you relieve it? If you calculate 66 to third of assessable profit, it is like 2 million and something. Calculate it though. So when you say this 2 million and something, and that money is even greater than this, it means you can allow for everything. So just have 1,486,667. So when you do that, you also less it here, 86,667. It means you have nothing, you have no unabsorbed, right? And your total profit here will be 2,013,333. That will be your total profit. You calculate your CIT and calculate your EDT. You don't answer that. And let's go to 2016 year of assessment. You start with your assessable profit. 1,500,000 as accessible profit. And then capital allowance for that year is given as how much? Capital allowance was given at 870,000. So you calculate 220, and there's nothing you're bringing forward. So when you calculate 2/3 of accessible profit is more than 870,000. So you can relieve everything. So when you relieve everything, you have taxable profit of 630,000. Taking note of this under. Be taking note of this taxable profit. See, this total profit or taxable profit. Take note of them because that is what you want to charge your unabsorbed capital allowances against at the end of the year. Not these companies ceased operations. You understand? So 2016 year of assessment, you have taxable profit to be this. What am I saying? Taxable profit. Total profit is also called total profit or taxable profit. So you calculate your CIT and calculate your EBT. Then 2017 year of assessment, you have your assessable profit to be 1,700,000, And then your capital allowance, nothing bringing forward, your capital allowance for the year is 850,000. When you calculate 66 to third, it is more than 850,000. It means you can relieve the old 850,000. Then you have a balance of 850,000 as your taxable profit. Okay, then let's go to 2018. Your assessable profit was given as 1,200,000. Immediately after your assessable profit, the next thing to deduct is capital allowance when you are on your journey to computing company income tax. So there's a format. Just make sure you watch the introduction video and also do your own personal revision. So you have your capital allowance to be 730,000. Okay? So you can absorb everything. After you do that test, then you have 470,000. So this is your total profit. Calculate your CIT, calculate your PDT. Okay? Then let's go to 2019 year of assessment. You have your assessable profit given as 950,000. Then you have your capital allowance as 950,000. Capital allowance is also 950,000. Can you absorb all? No, because obviously it's more than 66 to third. The restriction is 66 to third. But if it's the manufacturing company, you absorb everything and the balance will be 0. Okay? So this you can't absorb all because this is more than 66 to third percent. This is 100% of assessable profit. So get 66 to third percent. So 66 to third of this will give us 633,333. This is only what you can absorb. We know they do pass ourselves in terms of taxation. There are rules guiding all these things, right? So what is unabsorbed is 316,667, and your taxable profit or your total profit will be 316,667. Of course, that's because the assessable profit and this thing are the same. You understand? So you have your total profit. Here is your restriction to 66 to 30% of assessable profit, and here is your unabsorbed capital allowance that you carry forward to next year. Then after your 2019 year of assessment, you have 2020 year of assessment. I know that 2020 year of assessment is 1st of January 2019 to 31st of December 2019, right? So you check what is the assessable profit for 2020 year of assessment, that is 2019 accounting year. You have 780,000 naira. Okay, then ask yourself, what is the capital allowance? This is assessable profit. Then what's the capital allowance? Is there anyone brought forward from the previous year? Yes, you have brought forward of 316,667. Then what of for the year? Check your question. For the year, you have 990,000. So if you the total capital allowance to be relieved in 2020 year of assessment is 1,306,667. Can you relieve everything? Impossible. You don't even have to do the restriction test first before you know that you can't relieve everything. Okay? So what can you relieve? You can only relieve 66 to over 3% of the assessable profit. And when you do that, you get 520,000, right, as your restriction. Okay? So what you have as unrelieved capital allowance will be 786,667. Okay, you also relieve this 520,000 from this to get your taxable profit to be how much? You have your taxable profit to be 260,000. Taxable profit or total profit. Okay, then you calculate your CIT and you calculate your EDT. Now let's move to 20. Okay, this is 2020 year of assessment. This part I want to do is very, very important. Okay, so now they now said the company ceased operations when? They ceased operations 31st of May 2020. Now, 31st of May 2020. Remember Finance Act 2020? When did it come into implementation? It came into implementation 2020, right? So you should apply the Finance Act rule, right? So it is in 2020. What's the rule for cessation? The rule for cessation says just let the basis period be from the date of the beginning of the reporting period to cessation date, right? So the date they cease operation. So because this company ceased operation in 2020, we should follow the Finance Act rule. So we are definitely going to follow the Finance Act rule. So what is going to be our year of assessment? Remember, we are supposed to count 6 months from your date of cessation. The tax authorities have said you must file 6 months after your date of cessation. So 31st of May is the cessation date. So that's 31st June, Should we use 31st? End of June, end of July, August, September, October, November. We are still in 2020. So you say 2020 year of assessment. So there will be another 2020 year of assessment. So imagine the cessation date fell in July or August. If you count 6 months to enter 2021, so you write 2021. Is this small thing that the examiner is just looking for to fail you? Examiners, they're just looking for something to take from you. Okay, so you have 2020 year of assessment, and this is the cessation year, right? So you ask yourself, it's because of the space that I moved here, what is the assessable profit? Note that this period we are checking for is 1st of January 2020 to 31st of May, right? 2020. Don't forget, normally you're meant to write 2021 next, but because filing still falls, year of assessment means filing year, which year will you carry your document to start of this is my tax, I'm filing. So because it still falls in 2020, because of that 6 months rule, that's why you're writing 2020 year of assessment. So your assessable profit for that 5-month period, that one they gave you your question as 5 months to that assessable profit is what? 250,000. They didn't make much, and they closed the operation. Then what is the capital allowance? They know they are bringing forward, right? Brought forward, this one. So capital allowance brought forward is how much? 786,667. That one is clear. Then what is the capital allowance for the year? Remember in the question they said that balancing allowance is how much? 2,350,000. If you watch the first video, which is the introduction video, you know what balancing allowance is by now. Balancing allowance is also like balancing allowance is capital allowance. It arises when there is a disposal of an asset, and then the sales proceeds gotten from disposing the asset is less than the tax written down value. In summary, they made a loss. If this is the asset of the company, and because they are ceasing operation, of course, they will have to sell off their assets, This asset is costing maybe 5 million. That's the tax written down value, the value in the books at the date of cessation. And then they are only able to sell it for 3 million. It means there is a loss of 2 million. That's what we call balancing allowance. But if they are able to sell it for more, maybe like 10 million, that's what we call balancing charge. So this question is telling me that when they dispose, they had a balancing allowance, which is a loss of 2,350,000. You add it to capital allowance, right? Because it's a loss, you allow. If it's a profit, that's the balancing charge, you charge. If it was balancing charge, you add it to assessing profit so that you can push up the profit and you tax it. I don't know if that makes sense. So this one now means that the total capital allowance for the year is 3,136,667. Okay? Now, can you relieve all? And this is the final capital allowance. This is where the carry backward comes in. So this is the total capital allowance for the year. Can you relieve all? You can't relieve all. You can only relieve 66 to third because they did not tell you as a manufacturing company and they did not tell you as an agri company. All these small things, you always remember it, right? Because the examiner knows that you know it, but it's the rule that makes the difference. What's taxation? It's the rules and regulation, what the government has said. So you have restriction. So since this is the cessation year, this is the last year, the business is closing. Why are you restricting again to 66 to third? There's no point of restricting 66 to third because after this day, the business is no longer in operation. So just relieve everything that the profit is available to relieve. So what can this profit relieve? 250,000, right? To keep it at a zero balance. You can't even, so the taxable profit will be at a zero balance. So you can't charge anything, right? So what you could only relieve from this amount was just 250,000. You understand? To still leave you with a balance of 2,886,667. So this is your unrelieved capital allowance. Carried forward to where? Where are you carrying it forward to? You can't carry it forward to anywhere, right? So it means that this one is a carried back capital allowance. You now carry it back. So what do you do next? You do your normal CIT at 30%, another one 0, then your EDT at 2%. Downward, it will be 50K now, 5K, 2% of this, that will be 5,000. You understand? So don't forget to always do your CIT and EDT just because of time. I'm just letting it. Because you can see an outstanding capital allowance that has been unabsorbed. That's how the whole concept has been unabsorbed, which is the reason we are even solving this question in the first place. You now carry it back. You now write carry back capital allowance. Now, what does the law say on this? What does the law say? The law says if there's an unabsorbed capital allowance, carry it back from the penultimate year. Yeah, the penultimate year is the year before cessation year. The year of assessment before the cessation year of assessment. Okay. So you can't carry it against the profit for this particular year of assessment because it's already absorbed, right? That's why we didn't do any restriction. Just clear what it can clear. So you start from here, penultimate. You know this is what we call ultimate year. So penultimate year, this year of assessment here. This capital allowance, right? Don't write it like this. Unabsorbed. There's no format for this one. Capital allowance. 2,088,666,667. So what do? You would reduce this balance and amortize this balance against the total profit or the taxable profit for 5 years. After 5 years, any balance that is remaining will be deemed lost. Okay? Any balance remaining will be deemed lost. So you start from this one, right? 2020 year of assessment. If you like, write the accounting period there. It's just proving that you understand it. What's the total profit? 260,000. Then 2019 year of assessment, 2018, 2017, right? 2016. These are the only possible year of assessment that, because then you stop after 5 years. We don't know yet. I think it's by the 3rd year that this amount would amortize finish. You understand? So these are the year of assessment that the law permits for you to go and claim. You are going back to claim it. The law says that the FIRS will refund the tax, because when you go back to go and claim 260,000, what does it mean? It means you cancelled out 260,000 and kept your total profit or taxable profit at 0 balance. So in essence, you are trying to say the tax authority is paying back to you 30% of 260,000, which happens to be a particular amount that you saw as CIT there. Do you understand? The law says the tax authority will refund that money, but they never refund it. As in, I don't know if it happens in practice. I've never seen that tax authority will pay back. They will refund tax if you have tax credit. But because they are season operation, they said the tax authority should refund the tax. Okay, so so there will be a particular balance. This will be like 220 something thousand that still remains outstanding after this 260. We're going to claim it over the next one, 2019. Look for 2019 profit. Where is 2019 profit? Look at it here. Look at it here. 316,667. Right? 316,667. After you claim this, there will still be something outstanding. You are punching out on your calculator, it's not my business. Then you go to 2018, this one, you go and claim this 470. You're automatically cancelling it out. You understand? You're automatically putting the taxable profit at 0 balance. So it means the tax authority will refund that particular tax back to you. They will refund this one. They also refund this 470,000. So effectively, it means it's 0 balance tax like that is there. Meanwhile, you already paid the tax, but they will refund it, right, in the cessation year of assessment. So there's still a balance. This amount cannot amortize this. You can see that on your calculator. Then you go and claim over the next one. 850,000. There's still a balance. There's still a balance, about 1 point something. I don't want to waste time. So you go to the next profit. We've taken this one. So you go to this one, 630, and that's even the last one because it's 5 years. Even upon that 630, this ultimate company, they still have some balance. I don't know, should we just quickly calculate that? They still have a particular balance. Let me just calculate it. Let me just calculate it. 2,886,000 minus 260,000 minus 316,667 minus 470,000 minus 850,000 minus 630,000. Can you see? They still have a balance of 359,333. This one is deemed as is lost. It has already elapsed, or what's the terminology? So they can only claim for 5 years. Why is the capital allowance so much? But this example is just to show you what the rules say. So if you see a question in the exam, which I don't think you see, you're writing professional, you're writing advanced tax, you can't see this kind of question. You're going to be reading petroleum profits tax and CIT, competition of company income tax, testing Finance Act 2020 and all of that. These are the total profits you can claim 5 years upward. If it ended in this place, if it was satisfied at this level, you stop at that level. So add all those tax and now write in your report that tax authority will refund so amount. Those CIT you calculated in your note, that's it. Tax authority is going to refund so amount of tax to ultimate co blah 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 blah. Now what do you notice in this thing? They will still pay EDT. EDT, education tax, tertiary education tax, is dependent on accessible profit. It's 2% of accessible profit. If you notice in this situation here, you still pay 5,000 on education tax. You understand? So it's only CIT. Capital allowance just directly relates to CIT. Okay? That's why it's total profit that you're using to set off unabsorbed capital allowance. Does that make sense? If you watch the video to the end, give it a thumbs up and also tell me other video ideas that you want me to do, other topics you want me to do. My channel is not just about accounting. You people should watch my other content, okay? It's not just about accounting. Tell me other things you like me to, other topics you like me to treat, maybe in taxation or SFM or maybe accounting, like corporate reporting here. So thank you so much for watching my video. Give it a thumbs up and of course, I'll see you in my next video. Bye!